Okay.
MTN is the one which is better.
I'm saying you can just be changing any of the two. But yeah, but we can start. I hope
Yes,
you're able
because
to.
I use the Airtel.
Okay. But are you able to clearly hear me?
Correct. We are able to hear you.
Okay, beautiful. If you are able, then that's okay. So last time we met, guys, we looked at the most structured way of working out a group accounts question on statement of financial position, or what you call as balance sheet. So the 5 stages, well, one, the first working that you do is to get the group structure. You have to find the group structure, or you have to determine the group structure. In this case, you need to know what shareholding is the parent company. What remains as the non-controlling interest? How much investment have you made, which is above 20% and less than 50% as an associate? So you first have to determine the group structure. Once you are done with the group structure, then now you go to the net assets in the subsidiary. Remember that you are the parent company who has actually bought, theoretically, more than 50% of the shareholdings. So you need to determine what is the net assets at the report date, which is pretty easy because you check on what is in the balance sheet. What is in the balance sheet is a true representation of the net assets at the report date. Secondly, you also need to determine what were the net assets at the time that you are acquiring shares in what now is termed as a subsidiary. So you have at report date, which is current, you have at acquisition, which is the past. The difference between the two, it does show the value you have created or the value that you haven't created. At the time you started controlling the financial and operational activities of the company. Sidin, are you getting me?
Yes, I'm getting you very clear.
Sure, thank you so much. So that difference, that is what you're actually going to call post-acquisition. Now, when you're picking these net assets,
Getting you now.
Sure, thank you. When you are picking, when you're coming up with a table or a schedule of the net assets in the subsidiary, you are not going on top there on the balance sheet, or what you are now calling as statement of financial position. Someone old school, I will still maintain a balance sheet. You are not going on the first half of the balance sheet where you have assets to start checking proper plant and equipment and all those things. No, you are not going to do that. You are going to pick the net assets. So the best way of picking the net assets and the diluted assets which fully belong to the equity shareholders will be picked under capital, or what you call equity and reserves. So there, guys, you just copy and paste the elements that you find under equity and reserves, which is basically the share capital. There you're going to find the share capital, you're going to find the share premium, you're going to find the retained earnings. You could also find the revaluation reserve. Sometimes the examiner is not going to include the retained, the reserves at report date, but we'll give you the story that those land that was revalued from this to this, or a building was revalued from this to that. But at the time of preparing the financial statements, it wasn't included in there. Meaning that the net assets in the subsidiary will need to cover that component that wasn't factored in the statement of financial position. Now, that is basically working tool. So on that working tool, why do you need it? It is very important for your subsequent computations in one, goodwill. Secondly, NCI, which is non-controlling interest. Those days we used to call it minority interest. Thirdly, group retained earnings. So the net assets at acquisition will fit nicely in your goodwill computation. Your post-acquisition, net assets at post-acquisition will fit well in both the NCI for the post-acquisition NCI and in the group retained earnings. The net assets at acquisition will fit well in the goodwill computation, like I said, and in the NCI computation, but only just that portion for the, or at acquisition, sorry. So once you are done with working tool, and it has to be very systematic to you. Once you are done with working two, seeding, you proceed, you go to working three. I need to even do like this so that you're able to see me.
Sure.
So you go to working three. So with working three, you look at goodwill. And like I said, goodwill is just some proxy word of saying you did not strike a good deal because you have spent more than the book value of that particular entity. You have bought the shares expensively. You get me? So if you have what you have spent and what you think the NCIs have spent in acquiring these shares or a stake in company B, less the carrying amount, and what you have spent and what you think the NCI has spent, whether you're using proportionate or fair value method, if it's higher than the carrying amount, meaning that you haven't made a very good bargain. But to comfort yourself, you're going to say it's goodwill. You are actually paying a premium because of the position at which your company is. The brand for that particular company, you come up with all sorts of excuses to justify why you actually bought this entity at a higher price than its carrying or net book value. So when you go to Goodwill, you're actually looking at the full Goodwill computation, meaning that you don't just calculate Goodwill just for you as a parent undertaking, or just a portion of what you have actually acquired. If you have acquired 55%, you are not going to compute Goodwill for the 55% equity shareholdings that you have bought. You have to do the 100%, which is a full method. But how are you going to do it? You have intel, you have information of how much you have spent sitting, which is the cost of that investment. Others will call it fair value consideration. That is you as now the parent company of how much you have actually spent. So you will include that line. Since we have already discussed this, I'm just trying to remind you of what you're supposed to do. So include that line. But in calculating Goodwill, you have to calculate at 100%. So meaning you need to estimate how much you think the NCI must have actually bought the shares so that you have the 100%. But you are not a forensic person to start now asking about how much this NCI bought. And obviously, there are quite a number of these shareholders that you cannot bring them in one group and determine how much they actually spent in acquiring shares in that company. So the best thing you can do is to look at the net assets at acquisition, which you are going to get in working two where you have done the net assets in the subsidiary. So the net assets at acquisition in the subsidiary times the non-controlling interest percentage. If you bought 75% of the shares, then 25%, that is what you're going to use to compute what you think proportionally must or could have been spent by the subsidiary. Because you do not have intel. If you had the intel of the actual amount that was spent, you plug it in there. But you don't have that and you don't have time. So you use the proportionate of the net assets. You are assuming that whoever bought these shares from the minority shareholders, though that term they have stopped using it, they are from the non-controlling interest shareholders. You assume that they actually looked at the carrying amount of the business, the net assets at acquisition times their proportionate share, and it's called proportionate method. Guys, are you getting me, Monvera?
Oh,
Are you
yeah, getting
me?
you.
Yeah. So that is the first method. The second method could be the fair value method. So with the fair value method, in the exam, you'll be given that amount. That amount in the corporate world, in real life, Sidney, maybe you have someone who has done evaluation. So is able to determine the NCI fair value, which you are going to use, and you ignore the proportionate method. So once you have those two figures, you add them. It then gives you an idea of how much you and the other shareholders could have spent. From your side, you know how much you spent. From the other side, you don't know. So you're actually using assumptions. As a person that has been in the budget office for so many years, now obviously I'm not in there, we work with assumptions. For a person that has been doing a lot of modeling, we work with assumptions. But those assumptions have to be auditable, they have to make a lot of sense. So once you add that, what is coming from you and what is coming from the non-controlling interest, less the carrying amount on the net book value, which is still you get it from working two under the net assets at acquisition, just that total amount, that's the one you're going to plug it in there. So I say, this is so much that we spent as a whole, and this is the book value of this particular business. The difference, obviously, it will give you the goodwill. Or negative, those that used to call it negative goodwill, which is immediately written off in your income statement if you get something different. So seeding, that is working three, and you will need to be very methodical in the way you look at a group accounts. Then it becomes easier to tackle them, to tackle any question under group accounts. So after you have done your working three on goodwill, you then now go to the NCI. Remember that the NCI, even when you look at the way the balance sheet, or what you're now calling as a statement of financial position, the way it is structured, the NCI is between equity and liabilities. And there's a reason for that. It is part of equity. The only problem is that you who has the significant control, you are not the owner of that component of equity. It belongs to other shareholders who you have decided to call as minority shareholders. So it sits in between. So it's still part of equity, but that is not your equity. So the first part of equity, that is yours. So you have segmented it. This is mine. This is another equity, but it belongs to these guys. Then thirdly, you now, so under NCI, sorry, I was distracted by my daughter. Under the NCI, this is how you compute your NCI. It is in two strands. You have the NCI at acquisition. You have the NCI post-acquisition. So when you add these two, you should be able to find the total NCI. So the NCI at acquisition, you go to working two, which is the second column in terms of the numbers, not the report date. You pick at acquisition and compute just that component, multiplied by the NCI percentage. That is what will come and sit under the NCI computation as at acquisition. So, and while you are doing that, it is possible to go to the report date under net assets, Hatofa, to go to the report date and just multiply that, and you're still going to get the same NCI total. But you don't want to do that. You want to show the growth of your, if at all there is wealth creation. At the time that you invested in this project, at the time that you are reporting, was there any growth? Has there been any growth? This is why you are also showing the NCI at post-acquisition. That NCI post-acquisition basically is the difference between at report date, what was there, which is current, and at acquisition, then you get a portion of the NCI. So you're showing if it starts going in negatives, then there's a problem. So instead of creating value, you are diluting value or eroding value. So that is the basic on the NCI, which is working for. Now you go to working 5, which is group retained earnings. So under group retained earnings, we did actually say that you pick 100% of the parent company, the retained earnings. You pick the whole 100%. That one is undiluted and it's logical. It's your company as a parent company. So you're showing this is so much from my parent company as retained earnings. Then from the other component, remember that the other component of your post retained earnings has already been accounted for under the NCI. So you still look at the report date, less the retained earnings at report date, less at acquisition for the subsidiary undertaking, and only pick your portion because the other portion has already been picked under NCI. Otherwise, you're going to double count. So that is what you're going to show as group retained earnings. So we know the rules already. We know the rules. For assets, we add 100%. For liabilities, we add 100%. For share capital, we only pick for the parent company. The cost of investment, it is cancelled with your share capital, with your equity down there under the subsidiary. That is what gives you your goodwill. Now that we have looked at that, guys, we can move on. Hello, I hope it was making sense.
A lot of it. The only part is the evaluation reserve you talked about when it comes disguised. That's where.
Yeah, I'm sure we'll still look at some scenarios on that one. You need to actually pick it from the narratives. From the narratives, you'll be told that there was some evaluation of this. So you need to know. And maybe again, let me just explain this nicely. Let me explain this. First, understand the anatomy of the balance sheet, or what we are now forced to call a statement of financial position. The balance sheet is sectionalized into 2 categories. You have the assets on top. You have equity and liabilities. If anything, I would be so comfortable to say you have assets and you have liabilities. Ignore equity, because equity is also another form of a liability. All you have done, you have just brought in this money, your own money, and invested in this business. Remember that the business and you are 2 separate entities. So whatever you see down there, regardless of what it is called, the second half of the balance sheet is basically liability. But this liability, the question is, who is owed? Is it the owner of the company? Is it some third party? If it's some third party, is it long term? Is it short term? So if it is the owner of the company, this liability in Congole, we are actually going to call it as equity. but it will be a liability. If it is for the third party, is this Nkongole or liability? Is it interest bearing or not interest bearing? Is it short term or not short term? This is where, is it coming in because we got some goods? This company got some goods from this third party. That is when you start calling it as trade payables. Or it is a loan because it is interest bearing. So the last half of the balance sheet, which is basically liabilities, like I've said, this is where you're getting the funds that should be able to fund your assets on top. And this is so important, even when companies are investing in capital investments, what we call CapEx. They need to know whether they are investing in lazy assets. Because if it's lazy assets, most likely those assets will not be able to pay the liability down. This is why you find that there's an imbalance between the liabilities and the assets. Because you are buying lazy assets which are not able to cover the liabilities down and to start growing your last half of the balance sheet on retained earnings. So the moment you get to understand this thing, Sidin, that what you have on the last half of the balance sheet must be able to balance what is on top, must be able to fund what is on top, then it becomes very easy for you to balance any balance sheet, regardless of whatever cave balls they'll actually throw to you. In this case, the examiner. Because if the examiner said there was some revalued assets or land was revalued at 10,000 kwacha dollars, and it is not there in the balance sheet. So you will know that under property, plant and equipment, there on land, you are going to actually debit the assets and you credit the liability down. So you debit the assets so that you increase your asset level, property, plant and equipment, because that revaluation wasn't taken care of. But it's not going to balance if you don't go down. So you are not just going to go down directly there and go on a revaluation reserve. You go in the income statement where, if you want, you can show revaluation reserve surplus, which will come under comprehensive income, where you're going to put that number. So ideally down there, under your profits, that profit should just come direct into the balance sheet as retained earnings. But you're smarter than that. So you're going to come up with your property, plant and equipment schedule. Or you're going to come up with what we used to call those days when we used to write SEMA. We used to call it sources, statement of changes in equity, where you're going to show the retained earnings. That amount comes in nicely, but then it's segmented, where you debit retained earnings, you reduce it, and you increase the revaluation reserve, so that now you can post them nicely in the balance sheet. Sido, Wambea, have you heard? Sidin, I'm talking to you.
Getting you, sir, loud and clear, coach.
So it's just, I'm giving you just, this is like a story, a financial story. I'm trying to create these practical pictures. Sometimes when students are learning these things, because they are more focused on exams, you restrict yourself from logic, from street logic.
Oh,
But this is a story I'm giving you. I hope it makes
yeah.
sense.
It makes a lot of sense actually. Before, you just have to study for passing, and you come back confused. You don't even know what you're talking about.
Mhm.
That's why we interchange them when it comes to writing.
Mhm.
But with this story behind, confidence levels are coming because you know what you're talking about.
Mhm. So now we go to the adjustments. We now look at the adjustments and the story behind the adjustments. One thing for sure that we all know is that the subsidiary company and the parent company, they are two separate entities who by law, they will be required to prepare separate financials. I always relate this with couples in these homes. In reality, a wife and a husband, they are two separate entities. They breathe different. They have been given different timelines to live on planet Earth. But biblically, we are told they are one. Even when they are trying to consolidate their wealth, they'll consolidate it as one. If the husband owes the wife, as individuals, the husband will say, I owe my wife 200 kwacha. The wife will say, I'm owed by my husband 200 kwacha. So the other one is looking at it as a payable. The other one is looking at it as a receivable, a promise that she's going to receive this 200 from the husband. A commitment from the husband that he's actually going to pay that 200 that he got from the wife. But then, when now we are trying to consolidate the wealth of this family, of this household, we will have to cancel the 200 kwacha that the husband owes the wife. We also have to cancel the 200 kwacha that the wife is owed by the husband. Otherwise, it's not going to make sense. So this is what these principles, these adjustments are basically logical. These are intercompany balances. So we're going to remove the payable and we're going to remove the receivable, depending who is owing who. If it is the parent company that owes the subsidiary, meaning that in the parent company's books, we are going to flush out that payable, that obligation that is owed to the subsidiary. And in the subsidiary, we're going to remove the same component under receivables, which the parent company owes. So it is just a logical adjustment that we do even in our day-to-day lives in these homes with our couples. Sydney, does it make sense?
It's a coach.
Sure.
It
Thank
is.
Thank you so much. Thank you. We are still on adjustments, group and subsidiary. The other thing would be what we call cash in transit. Similar principle. The subsidiary, if the subsidiary owes the parent company, the subsidiary maybe uses a check to pay the parent company. So in the books of the subsidiary, because they have taken the check to the bank, they will certainly cancel that debt, that liability, isn't it? But from the side of the parent company, because the parent company hasn't received or it hasn't reflected in the bank on the bank statement, the parent company will still keep that amount as a receivable because they haven't received any money. It is still in transit. It hasn't cleared at the bank. Now, at the time of consolidation, you have that insight of what was happening. So you cancel, you need to normalize it and flush them out. So I'm saying step one, deal with the cash in transit first. Adjust receivers books to assume they have recorded the cash. So you have to assume that that cash has been received because the other party sent that money. It's just that it hasn't cleared. Then after you've done that, remove the intra-company trade receivable and payables. That's it. That's it. There's an illustration here in cash in transit. We are saying P has an intra-company trade receivable of 1,500 at the year end due from S. This does not agree with the corresponding 1,000 trade payables in S due to a check of 500 sent by S immediately prior to the year end. So what is happening? In the parent company's books, the parent company is still showing that the subsidiary owes it a 1,500 kwacha. Yet the subsidiary, they have pushed in some commitment where they have, or the subsidiary has sent or deposited or remitted, given out a 500 kwacha, which has been sent to the parent company. The parent company hasn't received that amount. So we are saying what is supposed to be done is to assume that P received that 500, meaning that now you're actually going to have a 1,000 in P's books, which is a receivable, and in the subsidiary as a payable, it will show 1,000 kwacha. That is it. Then once you have these two, you can cancel them. The payables and trade payables cancelled. But that 500 that is coming from the subsidiary is going to reflect because you are actually assuming that you have received the 500 as the parent company. So this is how the transaction is going to be recorded in the group accounts, which I have already explained. So going to inventory, similar principle as cash in transit. You have inventory in transit. You expect inventory from the parent company, for example. So as long as you haven't received it, you actually show that it is still a payable. So you debit inventory to assume that you have received the inventory from the parent company or from the subsidiary company, depending who is actually bringing this inventory. Then you credit payables, because under inventory in transit, you're assuming that this transaction is not on cash basis. So you debit inventory, you credit payables. Sidney, are you getting me?
Sure, sure.
Thank you, thank you. So that is how the transaction is going to be done. Then you also have unrealized profit. Here, this is what we are saying, inventory PAP, which is provision for unrealized profits. You imagine you are doing business, or your wife sells maybe sweet potatoes at a premium, at a profit. So she'll prepare these sweet potatoes, fried or whatever. Then once she's done, she goes to the market to go and sell them at a profit. You come with your friends at home. You want to support that business that your wife is doing. You buy those fritters, those sweet potatoes, fried at a premium. But you haven't given, if you haven't given those fritters, you haven't sold them to your friends. Meaning that there is a group, intra-group profit, which needs to be removed. So profit can only be recognized if those goods have been finally sold to the outside world. The outside world, in this case, we mean any firm that has bought which is not part of the group. Right?
Sure.
So, any intra-group profit which hasn't been realized must be cancelled. So then what happens with that inventory that the husband got, the sweet potatoes, meaning that those sweet potatoes, they are actually at a premium, there's a profit in there. But because the husband hasn't sold them to the outside world, that profit, we need to remove it. So we'll have to credit inventory by that PAP, the provision for unrealized profit. So we need to remove it. So we are crediting. Any credit, if you actually want to decrease your assets, you credit. Any increase in the assets is debited. That's what we learned in Frankfurt long time ago.
Yeah, Frankfurt.
So this is why you are actually crediting inventory, because you want to remove that provision for realized profit. You want to account inventory at the same level at which it is being accounted for by the wife. then you are debiting the retained earnings by the seller, because the seller, your wife, when she sold those sweet potatoes to you, which unfortunately you could not sell to the outside world, she recorded the profit. So that profit is part of the retained earnings, which has gone to sit comfortably in the balance sheet of the seller, who is your wife. But because this transaction is still within any house, those sweet potatoes that you bought, you could not sell them to your friends, who in this case will be defined as outside the world. Meaning that profit that your wife made hasn't been realized that it is wrong. So we'll have to cancel it. So we are reducing inventory from your side as the buyer. We are also removing unrealized profit from the seller under retained earnings. Is the story okay? I know you have to play this video nicely, because it's just a story I'm giving you, a financial story. Yes, it did.
Well, actually, the wife makes sense because you know that your money, even when you have bought, it's like you are buying from yourself.
Yeah, certainly.
So it's creating a lot of understanding.
Yeah, sure. Thank you. That's a memory pegging is always important. So these are just basically the adjustments that you make. So what are you adjusting here for the seller? If S is the seller, you're adjusting working 2, which is on the net assets. The net assets in the subsidiary, they are at post-acquisition, whatever, you're adjusting that. If P is the seller, who had already made a profit, you are adjusting working 5, where you have the group retained earnings. They're basic principles, but these principles is all logic. If you are not going to adjust S, meaning that your net assets will be high because your inventory will have that component of unrealized profit. If you don't adjust P in the group retained earnings, your retained earnings will actually be overstated by that provision for unrealized profit. We end here for today's class, and I'm going to post this lecture immediately so that you go through the story.
Okay, now, just maybe it's some head up, because when you say you post on YouTube, I had difficulties last time. So
You haven't subscribed to my account.
So how do I go about it? I want to subscribe
so
now.
Go to YouTube now. Go to YouTube now and search Coach Carter's name, Fitzpatrick Apepe. Just search it there. Where I'm still online.
Yes.
Tell me if you found it.
So I go to YouTube.
Yes.
And I search for
my
Patrick.
name. Yeah. Don't miss the spelling. Check in case you miss the spelling. It's there on the screen.
And I search. Yeah, it does check your spelling. If different particular reference number is there or something.
FITZ, but just check the spelling. I'm sure you're getting it wrong somewhere. Check. Yeah.
Okay, I start with FITZ.
Yeah. Yes.
Okay.
Let me know if it's coming. Yeah? Sidin, what is happening?
I'm almost there. I was trying just to check the internet correctly. Okay. It's coming FITZ.
One word.
Patrick. Really, Patrick Kapepe is one word.
Fitzpatrick is one word.
Yes. Kapepe is a different word.
Obviously,
So
Kapepe is a surname.
Telling me there are no results. Maybe I use this one.
Yeah? Are you able to share?
The screen.
Yeah. Let me.
Yes, I can share.
Share.
So share. Let's top one. Yes.